Welcome back to Rockstock Channel. It is Friday, October 24th, and we are back with another of our, we said it was bi-weekly, but it's becoming, I think, more weekly Rockstock recaps, where Rodney, Matt, and I are having a rotating guest bestie. Today we have Eric Zaunscherb, who is ex-Canaccord sell-side analyst, but in recent years has become chairman of Critical Elements Lithium, as well as involved with GR Silver. And he's based in Canada and is going to talk about the TSX, uh, uh, um, market broadly and gold, silver, and lithium and valuations and the like, among other things. Before we begin, I just want to reference we've put a few other things out in a public domain that you should look at. Matt did his Recharge podcast, which we distributed here on YouTube as well, with Cormac O'Lair, where he made some comments about LME Week, which he attended last week, as well as the uh, China's aggressive new, BESS targets, which were referenced in Pilbara's earnings results yesterday. I put out a tweet last night highlighting that I thought that was a key takeaway from their deck and their conversation, is that they are forecasting 22% uplift to BESS over the next 3 years to benchmark minerals. Already aggressive numbers. We will be having Iola Hughes on the podcast in the next kind of couple of weeks to talk about uh, benchmarks, lithium forecast and BSS in particular. Also want to flag that we did interview Ernie Ortiz from Lithium Royalty Corp, which will also be out in the coming days, and point you to that. He was recently on a trip to Western Australia, looking at their royalty in particular for core lithium, but also met, I think, with Minres and Pilbara and had some commentary there, as well as recent developments in Argentina. I caught up with Alicia Milne of Q2 Metals in New York this week, which I have a short interview, which will be on the back end of this video to talk about that. And we're also interviewing Kobe Kushner of Libra Energy, which will be part of that Ernie Ortiz lithium royalty discussion. So please check out all of that. And finally, Matt emailed yesterday a summary of his recent blogs, and he's been publishing regularly at blogs.rkequity.com. He recently put out a 4-page discussion on the impact of how analysts are underestimating solar installations and how this is impacting, in his opinion, will impact upside surprises to all sorts of raw materials like aluminum and antimony, as well as lithium, and others. So just a reminder, please register your email at rkequity.com if you would like to receive Matt's blogs. This is the same email list that the Lithium Ion Bull is distributed at, but now we're putting out these emails, I guess, every 2 weeks, one from Matt and one from me. And again, finally, before we begin, I just want to thank our sponsors. Lithium Royalty is a sponsor, just mentioned them, but also USCF is a sponsor of ours. They are a provider of ETFs in a variety of commodity categories, largely focused on futures. They do have a sustainable battery metals ETF, ticker symbol ZSB, which invests in metals, derivatives, instruments, and equities exposed to the electrification thematic, including holdings in aluminum, copper, cobalt, zinc, lithium, and silver futures. And with that, welcome, Eric. You have some slides we're going to talk to about, valuations on, the TSX in gold, silver, and lithium. Why don't we start with that? Just why don't you introduce yourself to our viewers, and then Matt will dig into some of the slides.
Sure. Well, thank you. Thanks for having me along on this trip. Originally, I was a geologist and was executing exploration and programs, various commodities throughout Canada. Then, as you mentioned, there was a metals and mining analyst that lasted for a few decades, 1988 to 2019, and then ended up, as you mentioned, with Canaccord. Was the global coordinator of mining equity research. Since 2020, retiring, I've been a mining executive with several exploration companies, as you mentioned, including executive chair with GRSL Mining and chair of Critical Elements Lithium Corporation, and then finally as independent director with TriStar and Valkia.
Great. Great. Well, thanks, Eric. You've sent through quite a few slides. I think we will touch on some really interesting ones that stand out for me. I
So
think
are
you've
you
got...
saying they're not all interesting?
Oh, surely not. Surely I wouldn't say that. It's just that there's 15 slides there, and we've only got like 20 minutes to talk about. So I thought I would cut into the key ones. I think one of the ones that really stands out for me is slide 4 in your pack, which looks at basically 6 or 7 different sort of small cap recoveries in the mining space, or the Canadian mining space, over the last, what do you call that, 30 years?
43, actually.
43 years. Okay. And I think what's really interesting is that you've obviously sort of plotted these on from the level of the TSXV, and there's a sort of like average sort of upside sort of calculation. Do you want to just run through what the conclusion is there?
Certainly. And as you mentioned, this is the TSX Venture Composite today, but it's all its predecessors going back several decades. And the goal here is to see, using the venture composite as a proxy for the mining industry, for the junior mining side, exploration and development. What has the recovery looked like on these upticks, if you will? And so you can see these last 7 were in the 7th over that time period. And the average is 38 months in terms of duration and 180% in terms of magnitude. And you can see the yellow dot there in the middle. And that is where the average would plot if you started at the beginning of this particular one, which began in the 4th quarter of 2023. So you can see we're about roughly 2/3 of the duration and 1/2 of the magnitude relative to the average. So that's part of the reason I'm quite encouraged to think that this uptick has some legs remaining to go if we're measuring it against the average.
And if we look back over that time period, what's been the primary sort of driver in each of those cycles, or which commodity
Yeah.
rather?
Yeah, I think the first to move is always going to be the precious metal side. But the main driver would be a supply demand deficit. And so if we look at the best and longest of that was the 99 to 2007 run, that was a supply and demand deficit that occurred obviously as a result of the emergence of China as an economy. And the present one, I would suggest to you, is a supply demand deficit that stems from underinvestment. And so it's a supply driven one where we have not seen enough money going into exploration, development, and production. And consequently, we're seeing this supply demand deficit that pops up. Now, of course, this time around, we also have the economic chaos of the Trump administration and the uncertainty that generates. And consequently, precious metals are running as well, as we've seen a lot of currency debasement.
Okay. And obviously fair to say that in the 99 to 2007 event also we had quite an underinvestment in supply, coupled
Indeed.
with that substantial demand event as well. So
Yes.
interesting.
Yeah, it was longer and stronger because we did have the combination, but certainly it was the emergence of China that really that drove that particular run.
Okay. Okay. I mean, I think that's some fascinating numbers. Now, obviously, you're going to talk about gold. I don't know very much about gold. I'll be the first one to admit that. But I do know a fair amount about sort of silver and lithium. So maybe we'll trot on to sort of silver and lithium, and then maybe we'll come back to gold, and maybe Rodney or Howard can drive on that. But maybe if we start with silver, which obviously occupies occupies this very interesting position between being a precious metal and being an industrial metal. And I think, a lot of why silver has run up in the last few months has been down to sort of investment demand and basically tallying on behind gold. Now, obviously, I'm one of several analysts in the market that's very bullish on silver as a industrial commodity for its industrial usage, particularly in the sort of solar space, but also in other areas related to the energy transition. And, I think one of the most interesting charts I've seen recently is the supply demand work from the Silver Institute, which makes it very clear that over the last 4 years, there's been a very, very substantial imbalance between supply and demand in the silver space. But that so far hasn't really been reflected in prices in the way you would expect it to be in an industrial commodity. So what are your thoughts on the silver market at the moment? And I'm obviously very aware of the fact that over the last 2 weeks we've seen a hell of a lot of volatility, and we saw prices spike, and now they sort of seem to be correcting, certainly in the futures markets, less so in the physical markets.
Yeah, the key point you made is that it is both a precious metal and an industrial metal. And so we tend to see different capital markets, investors and analysts and so on, focusing on one or the other rather than the fact that it is interesting from both perspectives. On the precious metal side, we've seen gold take a phenomenal run, and I mentioned currency debasement. One of the charts I provided you shows that you would have bought over 3.5 ounces at the beginning of 2000 for $1,000 US, and that now has fallen to less than a quarter of an ounce. So that, to me, highlights the currency debasement that we've seen. And the same is true in the euro and pretty well any other currency you want. So gold, when it moves, it tends to pull silver along in its wake, if you will. Silver tends to be much more volatile and slower to start. And that's on the upside. On the downside, it also can fall much further than gold. So you have to be careful of that volatility from a precious metals perspective. But of course, from an industrial perspective, silver is phenomenal. What we've seen with the solar panels, the voltaics, that amazing the industrial demand that has occurred as a result. And this consequence of that is how physical inventories have been cleared out. And so that feeds the kind of frenzy that we have been seeing. It also feeds the frenzy that we've seen, the volatility that we've seen just even in the last few days.
Eric, if you look at the complexity around the ability to ramp up silver production globally, how does that compare to some of the other commodities we look at?
Yeah, silver is a bit odd in the sense that it's not the master of its own domain, to steal a Seinfeld quote, in the sense that the vast majority of silver production is as a byproduct. So whether that's a byproduct of gold mining or a byproduct of base metal mining, lead, zinc, something like 10% to 20% of silver production is primary. And so these mines, the majority of which are byproduct silver, are not going to adjust necessarily to the silver price. So although we're seeing a run up in silver, that doesn't necessarily mean that all the copper and silver, copper and base metal mines and the gold mines are going to ramp up at the same time. It makes it very difficult for silver to adjust to pricing changes.
Yeah, so the lead lag on this, I guess this plays into what Matt's been saying and what we've said for some time is people keep underestimating solar, and therefore no one ramps up to meet solar demand, and then there's just a constant lag because everyone's trying to draw some kind of a linear growth pattern on that, and it's just proving to be much stronger.
No, and it's always true of the entire mining sector, is that people underestimate the time that it takes to bring a new discovery into production. It can be decades long. I mean, when we look at, you mentioned that Critical Elements is a company I'm interested in. That discovery was made back in 2008. Here we are in 2025, and despite having a very robust project, is not in production yet. It takes years to advance through technical studies. It takes years to get permitted, and then it takes years to build.
I think you're also touching on an important point, which you said is it's more volatile than gold. So like lithium, Howard always mentions this. I think it's been the best performer 4 years out of the last 10 and the worst performer 4 years. So timing anything like silver up and down, you need to kind of catch a steady run, and it's not as big and as liquid. So it's harder to know when to start and commit capital, I guess.
Correct. I mean, if you look at year to date, gold is up 65% and silver is up 76%. So it's been the outperformer, but many years has been the worst performer amongst the metal suite.
Can we move on? You've got a really interesting chart here on page 12, looking at the valuations, so the in situ valuations of silver explorers, developers, and you've plotted it in a way that I haven't really seen before, in terms of EV per proven and probable ounce, so that's reserves, EV per measured and indicated ounce of resources, and then the EV over the global resource ounces. Can you just talk us through that chart? Because there's quite a lot of moving parts there, but it's actually a fascinating chart.
Yeah, it's focused entirely on exploration and development. So one wouldn't value a producer on this basis. That's largely going to be on EV per EBITDA or other measured cash flow multiples and so on. So from an exploration and development perspective, we're looking at the enterprise value. And so that's market cap plus debt, less working capital. And that gives us a measure of what the market in general is valuing a company at. And then we're looking at the in situ number of ounces. So in the ground, as you mentioned, proven and probable, measured and indicated, and inferred. And so we look at the clearly there's a strong relationship, a strong correlation with price. As price goes up, we see these things moving up. As price collapses, we see the valuations move down. But currently we're looking at something like $5.50 per ounce US in the ground, whether those are proven and probable or measured and indicated resources, and about half that or less than half that for global. What I always find interesting is that the reserves you'd think would be valued much higher than measured and indicated, and certainly that was the case if you go back in the 2021 22 area. You can see a big spread between reserves and measured and indicated, but right now it's extremely tight. My theory on that is that we're looking at those companies that have reserves are also looking for money to put their projects into production. And the market is hesitant to provide the capital to put something into production. In fact, in some cases, and if you don't have to go back very long, you can see that 2P figure is hidden in behind the measured and indicated, so that the market is penalizing companies that are looking for money. And that speaks to what I said earlier on, that we're in a period of time where we're seeing supply-demand deficits as a result of underinvestment.
And
Capital
it's really interesting on that chart to contrast that with the gold chart, where you can clearly see that the companies with reserves are getting higher valuations than the companies with just resources. And absolutely fascinating to see that in the gold space, the producers are getting, or the very close to production are getting premium valuation, but they're not doing so in the silver space.
Yeah, I think it's a matter of timing. As we said earlier, gold tends to move ahead of and more strongly at the beginning of the cycle than silver does. And so I think with silver, as this particular bull market progresses, we're going to see that spread grow again as it begins to provide money for development, putting something into production.
Okay. Before we go into lithium, Rodney, do you have anything to ask on gold?
Now, I guess the only thing on that that I find interesting, Eric, is you look at not that, some players look at the technicals on it, but what you're seeing is it looks like it's overbought, but it's under-owned. So, the allocation across investment portfolios to gold is still, a lot of people wrote it off back in the day. Now, the question is, if you believe in the debasement trade, which I do, and that's why I own quite a lot of gold, is eventually, are we going to? We've seen gold eclipse the euro as the second biggest reserve asset to the dollar. Now, where do you think this, ends? Do we still see a continued shift in portfolios and central banks and so on to harder currency?
Personally, I believe that we will continue to see that. If you look at what are the conditions that have caused this debasement in currency, and I don't see a change in those conditions yet. I mean, gradually we see these metal prices increase, and there's a point where eventually capital is provided to provide new supply, and eventually things come into balance. I think we're a fair ways away from that as yet, and so consequently, let's keep on focusing on these metals and the opportunity that they provide.
And again, in terms of difficulty in bringing on a gold mine,
Yeah, I mean, some of them are spectacular. If you look at G Mining, how well they brought on that new mine in Brazil, it didn't take too long for them to do it. But that's the outlier. We see way more problems bringing these mines on than we see massive success stories. It's just the nature of the business. You're looking at the collision between Mother Nature and an engineer's brain, and oftentimes it isn't pretty.
and tell me, Eric, in terms of just to give the listeners, those who are more lithium inclined, relatively speaking, capex for a gold mine relative to value versus say lithium.
Wow, that's a great question. I think in terms of value that the precious metal mines can be, and that's a very broad statement, can be more valuable when you have an incredible discovery like Fruta del Norte in Ecuador, and several others that are world class, but the vast majority aren't world class, are they? Lithium, as we all know, is one of the most common elements on the planet in the crust. At the same time, how many of these lithium deposits are in a jurisdiction that is safe, are economic, are in a location that can be delivered to the market? And then there are very few of them. So I think finding a lithium deposit is still extremely valuable. The hard part, again, is getting it to market, taking the time to bring it to market.
Okay, and let's shoot on to lithium valuations, because your lithium valuation chart is quite a substantial contrast to your gold and silver valuation chart, insofar as the gold and silver chart valuation multiples have increased substantially off the market trough, whereas lithium not so much. I think it would be fair to say. So, can you just talk us through the high points of that chart? I mean, that's a fascinating chart. It goes back till the back end of 2016, so it's got the entirety of the last cycle in it. In fact, the entirety of the last two cycles.
Yeah, I mean, let's start off by reminding investors that the lithium and related markets are not mature, that we're talking about a specialty chemical. We're not talking about a metal that has been traded for centuries or millennia even. So it's immature, it's illiquid, it is dominated by massive players, both on the end user side and the producer side. And so it's subject to the vagaries of the market. I wouldn't say manipulation necessarily, but there you have it. Shorting, short covering, and such. Yes, we're seeing 65 to 75% gains year to date in silver and gold, whereas spodumene is virtually flat through the year. So those valuations have definitely not picked up. And if you look at it, you can see the massive spread between where we're valued today, whereas back in 22, we had these incredible peaks of valuation. Are we going back to that? No one really knows, but I would suggest that the vector is upward, that we are trading, where spodumene is concerned, at a level that is unsustainable. If we want new, we want to feed the demand that we're obviously seeing in electric vehicles and BESS, then we definitely need to see more mines, and we're not going to get them at these price levels. The price must go up.
I mean, I think what's really fascinating is obviously if you look at the amount of lithium resources that were extant in 2022, for instance, we're talking maybe 400 million tons of LCE, and now there's just shy of 800 million tons of LCE. So we've doubled the amount of resources that we've discovered, yet at the same time we've derated our valuation quite considerably.
Correct. And, as we said earlier, there's a lot of lithium around, but there's not a lot of lithium around in a form that can be easily brought to market. And that's going to be the challenge. And it's those people that are observing the market and saying, there's lots of lithium out there. They're the ones that are going to get their fingers burned as we see demand rising towards that 2.5, 3 million times, 3 million tons demand LCE.
And you're right on that. I mean, on my numbers, I think something like 80% of the lithium resources that have been added since 2022 have been in DLE brine and sedimentary lithium.
Yeah.
And they're still not commercially proven at this time. But what does interest me is we've seen this huge derating in hard rock and salar brine assets, and they still look very, very cheap. And I would say that there's a scarcity value, particularly for these salar brines that are viable to extract by evaporation.
Yes, indeed. I'm hard rock with critical elements lithium. I tend to be focused more on the hard rock side. To me, that's conventional mining in a conventional mining jurisdiction, as you mentioned, DLE and some of these clay-based are fascinating experiments and yet to be proven on a commercial basis.
Okay, cool.
Eric, I want to dig in a little bit into some of the Quebec lithium plays, but and then broadly, the TSX dynamic, because Canada and the TSX has largely been known as a gold kind of market, and valuations in lithium have always been discounted relative to Australian listings. But they also do like exploration a lot in Canada at times. And we found earlier this year in niche metal, cesium and power metals, that stock rose a lot, but Winsome, which has a Quebec project, their valuation, hasn't risen much. In critical elements case, you have similarly a 20% economic interest in what used to be called, I think, Power Nickel. Now it's called Power Metallic. Could you talk about that? And you were also recently at the Beaver Creek conference, you were largely wearing your GR Silver hat, but there was some sentiment, I guess, on lithium that maybe you could share, and yeah, just positioning critical elements, from a valuation point of view, and then we'll also, start with that.
Sure. Well, let's start with the Beaver Creek. Beaver Creek, the Precious Metals Summit, is one of the most important precious metals gatherings for investors, the capital market side, and based on its name, obviously, is focused on precious metals. And so that was entirely the focus of the conference. My intent there was to remind people about lithium, actually, and critical elements. And about 1/3 of the people said, forget it. It's way too early for the lithium theme. 1/3 was like, yes, we agree. And we've already begun positioning in the producers, the larger companies, and we'll go down market as the bull returns. And then 1/3 was genuinely surprised and was grateful to be reminded to look at that lithium theme again. So that's roughly the spread of interest in the lithium space there. Coming back to your original point, critical elements controls over 100 kilometers of strike of what's called the Nemaska break or the Nemaska belt, within which one of the smaller blocks is called NISC, and NISC was optioned to Power Nickel, now Power Metallic, such that we got a whack of shares of Power Metallic. We currently have over 10 million shares, or at the end of May, we had 10 million shares. We have a 20% carried interest in the NISC project and its Lion discovery, which is a high-grade copper discovery. And we have 10 million share or $10 million of our own. So if you take the valuation of critical elements, looking at the cash, the carried interest in the project, and the shares that we have, that basically explains the entire valuation of critical elements. So in other words, the free option on the Rose project and lithium there. So you're looking at a free option on a project that is one of the most advanced hard rock lithium projects in North America. And, if we look at the 2023 feasibility study and the sensitivity table, and we adjust the price, use the long-term lithium price there to roughly where the PMET feasibility study was released recently, you're looking at the NPV 8% going from around 2.2 billion to 1.5 billion. So there's an NPV 8% of 1.5 billion sitting there with a free option.
Interesting. We hope to have JS, the CEO of Critical Elements, on the podcast before the end of the year. But he, alongside Alicia Milne, who will insert a video shortly, were both in Japan and Korea on a IEQ Investment Quebec sponsored event. I think PMET was also there, and Nouveau Monde Graphite on the graphite side. But any takeaways you could share for the JS shared with you about the interest? Like, on the one hand, Q2 Metals is in early exploration, right? And this event was largely with Korean and Japanese strategics who tend not to look at companies until they have at least, a PEA. And Critical Elements is largely permitted and is ready to just get fully funded. But
Correct.
yeah. So if you could talk at all about that visit, and we'll ask you a bit more after that.
Sure. I mean, I think it was largely a flag waving exercise on the part of Investment Quebec to make sure that it was that Quebec's projects are front and center to Korean and Japanese corporations and users. I think it was very successful from that perspective, although one would have to say that those strategic investors and end users have been in constant contact even throughout the bottom of this market. And so it's a matter of waiting. When are these people going to pull the trigger, if you will? And I assume that will occur when they see the bottom of the market and they can see an environment where that investment will pay off, where they're not shut out of the United States and things like that. So it was successful. Let's just say that.
Okay, and the interest from the Koreans, Japanese, in Pilbara's conversation yesterday, and Pilbara has a joint venture with POSCO making hydroxide. It seems that as good as their spodumene sales were into China, one wrinkle was they seem to be slowing down a little bit on the hydroxide, and that seems to be because that's destined to Western automakers. But I've had some other data points where the Koreans and the Japanese are still extremely interested in battery energy storage, and nothing's really changed too much from their medium to long term needs and wants of this raw material. Any comment there?
As you're well aware, the shift that we see in the end use, the shifts that we see in the recipe going into the battery, the configuration, these things have been going on and moving targets, if you will, for the last few years. And I think that will continue to do so. Let's not forget the Korean and Japanese end users are extremely smart, extremely savvy, and will adjust to the market as it changes. We as suppliers have to be equally savvy and move with that market.
Okay, I want to turn. Did you have any more comments, Rodney, Matt? I'm going to think a little bit about the political dynamic at work in the world this week. Australia and the U.S. Signed an agreement. Pilbara referenced that they were part of are part of that dialogue. It is early days, but things like price floors, strategic mineral reserves are being bandied about. But Pilbara emphasized that their main focus and argument is shared infrastructure, right? In Western Australia, you have a lot of activity, but where the government could help are help in power and roads and things like that. So I was just thinking that Mark Carney was with Trump recently. Scott Bessent said they're getting close to to a trade agreement, but the shared infrastructure idea, seemed to be an interesting one that could be applicable to Canada. Matt, discussed, I guess, the idea of, I agree with you that price floors in lithium is unlikely, but it might be. Strategic reserve, we'll see. I've been arguing for that. It would be great if the US government or other coordinated governments with Australia were to step into either the spodumene or the carbonate market, and start to build a reserve. It would help push up prices to incentive price without picking a specific winner like they did with MP. But do you have any view, just sitting there in Canada, Eric, on U.S. Canada relations, the trade dynamic at work? Because that does seem to be a shift in the last 6 months from Liberation Day and a lot of chaos and a lot of disruption to now the whole of American government focused on raw materials, rare earths in particular, but lithium's part of this mix.
Yeah, I think it's a lot more complicated than we think. I think that on the surface we see a lot of volatility and a lot of emotion on both sides, but under the surface, I would agree that we're moving towards working together. I can't speak for either President Trump or Prime Minister Carney, but naturally one can see the two parties working closer together to establish a joint infrastructure and so on. In Quebec, you have an abundance of resources, pretty well everything that you need, and coupled with one of the cleanest, if not the cleanest grids in the world, with 98, 99% of the power generated through hydroelectricity and the remainder through solar and wind and so on. So that's a marriage made in heaven with the largest consumer to the south, immediately to the south. So the two parties have to work it out. Unfortunately, we see a lot of emotion in there.
Okay. Tesla also had their earnings today, and they were talking about 3 million cars within 24 months. And also very significant kind of energy storage. But I was referencing because we just passed the kind of 5-year anniversary of Battery Day, when Elon Musk had forecast by 2030 he'd have 20 million cars, but he kind of acknowledged that he slow played the ramping up of production until he was very even more confident on autonomy, which he now seems to be confident. We'll see if that plays out, but he made a lot of very substantive comment on on batteries and energy storage, and it just seems that there has been a very significant shift. We're lucky in lithium to some degree that we all thought this was going to be an EV dominated thematic, but what's happened over the past year is that electricity rates are going up like crazy because of hundreds of billions, if not trillions of dollars going into data centers, and increasingly with targets not just in China but elsewhere in the US. There's going to be a realization that batteries are critically important for the AI race, and that could be even bigger than the forecast we had, for EVs. And I think the market, and to Matt's, maybe Matt, you could talk to your blog a little bit, on the solar installations. It's much harder to forecast battery energy storage demand, because it just has so many disparate uses compared to just electric cars, where you're growing, and relative to ICE vehicles, and you're forecasting that growth and battery size, et cetera. So, Matt, why don't you flag your blog a little bit, and I think
Yeah.
we could wrap it
Okay.
up.
Well, I mean, I think it is. ESS is a very difficult market to forecast because, unlike EVs, where we have hot and cold running data on vehicle sales, split by model, split by region, split by country, we just don't have that sort of data on solar installations and battery installations and things like that. So you have to kind of make an assumption in terms of BESS penetration for um, solar and wind. And that's historically been the way that we forecasting best penetration for renewables. Increasingly now, with some of the comments that are coming out in the market, I think we can't just look at renewables. We have to look at hydrocarbon-based power sources, because a lot of people are suggesting that we need BESS in place to smooth out the flow and manage the flow of power into these data centers and other applications as well. So, it's not just a question of forecasting renewables, but I think the other thing is that over time we have seen BESS loadings in renewables increase substantially. So, the situation for BESS loadings, say 2 or 3 years ago, was completely different from the situation for BESS loadings now into the renewable space. And on top of that, you obviously have different applications of renewables and different applications of BESS. So, a lot of people are just forecasting BESS based on utility scale renewables, but obviously commercial and industrial, what we call CNI, and also residential, are going to be increasingly important at the margins going forward as well. So it really is a very difficult market to forecast. And on top of that, there are huge regional variations depending on the structure of electricity and power markets in different countries. So it's not it's not an easy market to forecast by any stretch of the imagination. And the legislative situation in China for BESS and for power and renewables is completely different from, for instance, the situation in Germany, which is completely different from the situation in the UK, which is different from the situation in California, which is different from the situation in Texas. So it really is extremely difficult to forecast as a market. Having said that, I do think 90% of analysts in the world are getting it wrong. And wrong in a big way, because they're under forecasting solar and renewables installations. And as a result of that, they're definitely under forecasting BESS. So basically, I've done a succession of blogs over the last 4 or 5 weeks looking at potentially what I would class as a realistic or more realistic scenarios for solar installations would look like, and therefore what more realistic scenarios for demand for various commodities and materials would look like as well. And the latest one is on BESS and also lithium. And let's just say if my most optimistic scenario came out, it would be very positive. Particularly in terms of lithium demand, where, in my model at the moment, I still got a surplus for the next couple of years. But if the more optimistic scenario on BESS came out, it would push my model into deficit probably within the next 2 to 3 years, which obviously has substantial implications in terms of lithium prices. So, I wouldn't say that I'm 100% there on BESS. I'm probably more bullish than 90% of the street. But am I definitive in terms of my models? No, my model is changing all the time, and it's rising primarily all the time as well.
Well, I think one area, and that's all great, Matt. I went to a conference last Friday called DERVAS, which DERs stands for Distributed Energy Resources. You mentioned a few other acronyms there, and the VOS was like, they wanted to make this. It's like the Davos for DERs. And I ran into Jigar Shah there, also Drew Baglino was there. He was Tesla's Elon Musk's right-hand man, and I was very flattered when he said he watched the videos we produced back then in Battery Day, where we took his snippets. So, but I think as much as you're underestimating, or the market's underestimating demand from solar and BESS, et cetera. These distributed energy resources, which, a lot of it's residential, it's smaller scale stuff, is becoming very economic. There's a resilience argument. There are lots of places where they get spoiled food if there are blackouts or whatever on when there are storms. But also there's a inexpensive argument, like electricity. Some data points like 1 in 6 people in America are behind on paying their electricity bill. Right, that's an insane number, and it's becoming a political issue. I think in 2 governor races, next week, it's the number one issue, high electricity prices. So last year, egg prices were up, and there was one podcast I listened to is like electricity, the new eggs, right? This is a kitchen table issue. And as a result of that, you can't have just, Chris Wright saying, anti-solar, like the the thing is batteries, right, is behind this, whether or not it's solar or wind. The concept of, having batteries to help level out the grid and help reduce prices, electricity prices, is absolutely essential. And a lot of the growth in Tesla mega packs, some of it was sold to his XAI, or Elon's XAI Memphis plant, which is, I think, a gas or a diesel plant, but he needed the mega packs to, I forget exactly, to load shift or, on the heating and the cooling. Mega packs were absolutely necessary. And I think we're going to start to see, just like everybody was saying, oh yeah, if Tesla signs an offtake agreement with XYZ, lithium company, that'll be great. We might start seeing, next era, a utility or Microsoft or Amazon, is signing offtake agreements to source lithium to support their data centers.
Well, I think there's another aspect in this as well, which is that, from what we're seeing at the moment, it's very quick to build a solar and storage plant. I mean, you can get one out the door in sort of 12 to 18 months, whereas you can drill as much as you want, but there's a huge bottleneck in gas turbines at the moment, and you're not going to get a CCGT gas plant or a gas peaker plant into production probably in less than 4 or 5 years with the current bottleneck in gas turbines. So, if you want to get electricity into the market fast, you have to go renewables because there aren't too many other alternatives. And I think that's something that a lot of people are missing out on as well.
And it related to that, though, is not just that. There's, as I understand it, like the grid is like, let's say 1 terawatt. I think Elon Musk said this, like the grid is 1 terawatt hour, but the grid is there to maximize for peak usage, right? But most of the time it's at 50 or 60% capacity. So to make up that gap, even without a new CCGT plant or a nuclear plant or a solar plant, if you could just more efficiently utilize that space, you'll have a lot more electricity. And the solution for that is batteries, right? And that logic is starting to penetrate the various arms of the U.S. government. So it's not just the generation of the solar; it's actually the distribution, right?
Well, and I mean, distribution is a big issue as well, because traditionally what you did was, if there was an area that wasn't using power, you pumped power from that area to an area that was using power. But you can't do that at the moment either because there hasn't been enough investment in distribution, and distribution is as tied up in planning issues as the mining industry is. So, you need these ESS projects to be able to store the power because there isn't enough transmission and distribution infrastructure out there either. And that's not just a US problem, that's a global problem, particularly in developed markets.
And to that point, though, a lot of what you said is that it's regulatory problem, right? So from a bottom up perspective, Trump's deregulating, and various arms of the government, things that I'm reading, they're recognizing this problem. And just like he's having an Operation Warp Speed, this has become like a new term. And I've been making comparisons to the China virus, 5 years ago, as Trump called it. It emanated out of Wuhan. The saber rattling of rare earths is now catalyzing a warp speed mentality in the critical minerals space, in the same way that we sought to get vaccines, and we did within 9 months. I think a friend of mine, um, Alex Grant, kind of said that Trump was trying to accomplish in 3 years what China has achieved in 30 years in critical minerals. And you're seeing that JP Morgan has followed, with the $1.5 trillion of investment. And it's not all critical minerals, but it's across a whole host of industries, including, data centers and the like. But specifically for critical minerals, Appian, a private equity group, has signed an agreement with the IFC, and Orion Resource Partners, I think I saw a Bloomberg article, with the DFC. So money is coming for critical minerals, in addition to policies with price floors and strategic reserves. But very importantly, again, is they're paying attention as well to the electricity needs and the regulations that are impeding the deployment of technologies like batteries, which are there's movement there in the U.S. that is going to support demand for batteries that is not being forecasted. It's in addition, it's on top of all of the stuff I think that you've started piecing together, Matt, right? Like what's happening in China, like, don't underestimate the United States' ability, here on that, was a takeaway from my visit to this conference last week. So with that, I think let's wrap that up, unless any of you have any final comments.
We do live in interesting times.
A blessing and a curse,
Indeed.
Chinese proverb. Thank you, Eric. Have a great weekend, and thanks, Matt and Rodney.
Thanks very much for having me.
Okay, what's today? Today is
October 20th.
Okay, so all right, it's Monday, October 20th. I'm here in New York with Alicia Milne, the CEO of Q2 Metals. She's going to give us a quick update on what's happened in the last kind of month or two. We did have Tom Woolrich talking about the site visit he was on, so we know you had a site visit, but what else has been going on? Trips to Korea or Japan?
So we had that site visit, which was full of analysts, bankers, friends of the company, and that was very well received. They got to walk on CO1 and they got to see the camp. Aside from that, we were in Korea and we were in Japan with Investment Quebec junket that they were doing, trade mission, with a couple other Quebec companies, and had some good meetings there. And now we're in New York, and we have a big docket of meetings lined up for tomorrow. And
what conference are you here for in New York?
The Hidden Gems Conference.
Hidden Gems, okay.
Yeah. And then we're doing a bunch of meetings on Wednesday, just separate from that. And then we fly to Toronto, do some more marketing there, and then we're off to explore in Montreal, where we are up for the the Discovery of the Year. Sorry. So that'll be on next Wednesday, I believe, is the gala where they announce who the winner is. So. Yeah, it's going to be a busy few weeks here.
And isn't there, did you have an award at the IMARC? What's happening at the IMARC in Australia?
Cool. Jason's in Australia, and him and Simon are down at the IMARC convention in Sydney. So they have quite a busy schedule this week down there as well.
Okay, so what are investors kind of saying? Look, the market for a lot of things, critical minerals, has been very strong. Your stock has been performing well. I guess what's just the overall reception to... from investors?
Yeah, it's been good. It's been having the exploration target in hand to say this is what the minimum and maximum tonnage is based off of the first 40 holes. Now we're up to 61 holes, 25,000 meters. So, that data is just going into the system. It's increasing the tonnage potentially. And people see it, they understand it, and they can sort of see what it looks like compared to some of the other projects.
So news flow between now and the end of the year and into next year?
We have assays coming. I think the biggest one will be on hole 44, which was that 457 meter hole, which was the second longest, widest spodumene pegmatite intercept worldwide.
the picture with you and the people in the drill hole, we've gotten good traction on that.
Yeah, that was a great picture. That was part of the site visit. I didn't think anybody was going to get down on the ground and lay around it, but they all did. So hey, we'll use it.
Okay, so assays pending
Assays
for
pending,
that hole, and
and we're drilling again. So right now we have 4 drills turning. So we'll just continue assays coming out.
and remind us when's the timing of the maiden resource and
That'll
PEA?
be Q1. So in my mind, I'm targeting mid-February for that.
Mid-February for the resource.
For the resource, that'll be an inferred resource,
Okay.
and we should have all of our resource drilling done by, I would say, mid to late November for that the 43101 report, and then we'll go straight into drilling for our PEA. So tightening up the spacing even more, and that should be done by goose season, so mid-April.
By mid-April, so the PEA should be out approximately when?
I would like to think sooner than not, but it'll probably
Like the
be
summer?
end of summer.
End of summer. Okay, so Q1 maiden resource, summer hopefully PEA. Okay, and hopefully rising lithium prices as you put that news into the market. So what was the feedback from your visit, the Investment Quebec visit? I think you mentioned Patriot was there, Critical Elements was there, Nouveau Monde was there, and it was to both Korea and Japan. So what are they saying? Are they still optimistic and need in spodumene?
Yep. No, the very positive feedback from the companies that we met with, from the governments that were there, from the Quebec government, and some of the higher up people in Korea and Japan that were there as well. So, it's looking up. It's time will tell,
Right.
But I think it's more of a when, not if, the price turns.
Okay, and you don't need any near-term money because you just raised $26 million to fund this drill program. Remind investors what was the price of that capital raise?
Yes, we did it. It was all flow through money, so that needs to be spent directly into the ground. That was $26 million that we raised at $1 a share. Our share price at that time was at 60 cents, I believe it was. So it was a nice markup that we got. And again, it's allowing us to accelerate everything that we're doing to get to that resource, to get to that PEA, because I think those are the next 2 big milestones for us to sort of solidify what we're seeing in Cisco.
Okay, the effective price in the market at the time that you did that financing was about 60 cents, and now the price of your stock is nearly $1. So it's actually risen quite a bit from that equity raise, and there was no warrant attached to that,
No
right?
warrant.
Okay, so you're preserving the capital structure, and your market cap, I think, is, as we've talked before, I don't know, about 125 million
100, well,
US.
Canadian.
I think in US dollar term. On the ARC equity scoreboard, I put it up there, so you're still like 1/3 or 1/4 the valuation of Patriot, but which is a benchmark, and we wish and hope Patriot should be a billion and a half dollar market cap, and you should rise in tandem with that story as well. Anyway, great to see you, Alicia. Welcome to New York. It's always good to see you in person.